Hi guys. So today we're going to talk about the correction. I feel like correction is one of the most, I guess you could say, important parts of ICC. So once again, if you don't know what ICC is, this is day three. ICC is basically the way that I trade, a three-step, um, I guess you could say, rule book that I use to be able to get my entries, exits, and my TPs. I think it's the most simple way to trade. So if you haven't already, go back and look at video number two. So video number one is very important for the fundamentals of ICC, but video number two goes over the indication. Yesterday, I had just flew into LA, so I was a little bit tired if you couldn't tell, but I'll talk about indication once again, and then I'll also go into correction, which is the most main focus for today. So first, we have once again we're going to start off with that same thing that we had yesterday. So we had those two levels, and this is where we can basically see what trend is going to be started. So we're going to go ahead and start everything here. Boom, boom, boom. And then we have this, right? So we don't know what the trend is right now. And like I talked about in video number one, you don't want to trade consolidation. Consolidation is when you don't get anything higher or anything lower. So no swing highs are being broken or no swing lows are being broken. And that will show you a consolidation. So we're going to mark this and we're going to say consolidation. I'm trying to get more into typing out what I'm saying so it's a little bit easier for you to understand. But yeah, so with this being said, we also have, let's just put swing high. I'm going to just start marking out everything so you can easily understand what everything is. And then we have swing low, right? Swing high, swing low, swing high, swing low. So all of these are swing highs. And these also will play a part later on as we start to describe market structure. I'm pretty sure that's going to be video number 5, market structure itself. It should have been the first video, but I feel like explaining to you what everything in ICC is in the beginning is going to help you, because then you're like, okay, I want to trade this way, I don't want to trade this way, before I start breaking it down into how to understand more of the markets. But if you feel super comfortable with learning the way that I trade, then continue to watch on. But these first 4 videos will basically let you determine if you want to keep trading this way or not. There's going to be, right now it feels super simple, but there's going to be things that I've learned along the years that can really help you elevate the game and keep it as simple as possible without having to learn all these different terms and all these different ways of trading. And I don't use indicators at all. So the way that we're trading is basically using no indicators at all. So with that being said, let's continue to break everything down. Right now we have our swing highs and swing lows. So in that consolidation, all we wait for in this level. So once again, also as well, we trade 1 hour and 4-hour time frames. Me personally, I trade the 1 hour. So personally, I use 1 hour pretty often. Pretty much in every setup that I've done has been mainly off that 1 hour time frame. There's times where I can use the 4-hour time frame to basically go into the markets and be like, okay, price is going to do this long term. So normally 4 hour I use for long term. So 4 hour long term swings. Y'all can see the energy give me today. Yesterday I was out of energy, so I'm sorry for yesterday. So I'm just going to explain everything today. And then this is more for my day trade swings. Day trade swings. So what I mean by day trade swings is normally what I try to do is I find a day trade and turn it into a swing trade, which is more of an advanced thing that we're going to get into later. But my 1 hour setups are something that I'm like, okay, today price is going to go in this direction. And then normally when I take those trades, it is based off what the entire trend is going to be. So I try to look for that initial position so that way it can lead into a long-term swing. Because I never like to just day trade and just be done. I kind of like to have that day trade, make that money that day, collect some partials, and then be able to hold long term. So it's kind of like I treat it as like a trade and an investment. So I invest long term into whatever the market is doing so I can catch the full trend out of it. So with that being said, normally whenever I'm marking up my charts to be able to see what we're looking at now, so what I'm seeing right now in the markets right here, I'm looking at the 1 hour or 4 hour time frame based off of how clear it shows to be. So If the 4 hour is clearer than the 1 hour, which in some cases it can be, then I would look at the 4 hour time frame. If the 1 hour is clear, then there's no need to go to that 4 hour time frame. If the 1 hour is already showing me a good amount of structure, and what I mean by that is, what I mean by good or bad is basically I can see the highs and I can see the swing lows, because there will be some cases where you're using the 1 hour time frame and everything's a little bit choppy, but you can see prices kind of going up or kind of going down. So you can see visually that price is going in one direction, but the 1 hour is a little bit more choppy. And what I mean by choppy is it's going up and down, up and down, up and down. But the 4 hour might just have, those clear highs and clear lows. So that is the time frame that I use. We'll get more into time frame later on down the line because it plays a big part in ICC, especially that correction phase, correction going into continuation phase, which is the next video. It plays a big part. Time frames play a big part in that correction going into continuation. So with all this being said, remember yesterday we talked about indication, but I'm gonna touch back up on it again. An indication can only come from, you can say it to yourself if you already know. Indications can only come from price breaking above a swing high or low. So put that to yourself, teach yourself that. Indications can only come from price breaking a high, breaking above a swing high or swing low. So our swing high, swing low, right? In most cases, most people will call this just a support and resistance, but I try not to teach myself that word, because support and resistance, normally when people think of that, they think of, oh, as soon as price gets to the support buy, or as soon as price gets to the resistance sell. And that's not always the case. You actually want to use the opposite of what you probably learned already, is at resistances, you're looking for price to give you that indication, because this is normally telling you when price is breaking a resistance, is normally telling you that price is having the potential to have bullish movements above and to go higher. So with this being said, let's think of it like this, and then I'm gonna go back into indications and corrections, right? So think of this as a price point. So each level has a price point, especially if you're using the higher time frame. And what I mean by price point is these levels cost money to break. That's why they hold so strong. So since they hold so strong, especially on the higher time frames, it costs a lot of money to break these levels. So these levels do not just break because the market needs to grab money in order to break these levels. So whenever price has collected enough money, so that's why you see consolidation sometimes, because it's accumulating the money together. And then once it feels like it has enough money to break out, it will have that big burst because it's gained so much money. It's like shaking up a Coke bottle. If you shake it up long enough, soon as you open the bottle, or as soon as it has the opportunity to break out, it's going to go everywhere. So the same way with these levels, like soon as price collects enough money and is shaking up the market, it's grabbed as much liquidity as possible, then it'll eventually go into the direction that it wants to go. So it could be up or down, and it gives us that breakout. It gives us that indication. And the thing is with this, right? So think of it in this way. When price normally breaks out, or like, let's say you open up the Coke bottle, normally it'll be a burst for, a small bit of time. And then you start to see it slowly die down and go away, right? And then it goes back into or like it spills everywhere and it's just like a mess, right? So think of the indication and correction being the same thing. The opening the Coke bottle, everything explodes everywhere. It starts to slow down, dies off, and then there's a mess everywhere. So it's the same thing with the indication and correction. So once price breaks out, there's this big explosion. Everybody's trying to get into a trade. Everybody's rushing to get into a trade. Everybody's trying to look for something. People are in buys. People are, if it's reverse, so if it's like option, yeah, if it's like this, if it's going down, then everybody's trying to look for that sell, look for that buy, and nobody knows what's going on. They just know that price is exploding. So with that, it causes a lot of FOMO, a lot of greed. And I used to be this way, where I used to see breakouts, and there was some that I profited on, but what I like to focus on is not what just makes me profitable, what makes it consistent. So what I can say is this normally causes FOMO. People get into the markets, they don't know how far price is going to go. So then they start getting into the markets, getting into random positions, and overall, losing money long term because this is not always going to work. It's not always going to explode 200 points or 300, 400, or it could just, do 10 points and then that can be an indication, right? So it's not always going to explode super far where you can make a lot of money and then close for that day. Some days are going to be a small move or a small break above or a small new high or a big new high, whatever the case might be. But to avoid this, just kind of use it, set your alerts. If price makes a new high, note that, because what today's topic is corrections. Corrections are very important in the market. Not all the time price is going to give you that correction fully of like how I'm going to explain, but I can teach you a way to understand how to know when the correction is over. So corrections are not always going to go all the way back to the previous level that it went to, but I'm going to teach you later on down the line the different types of corrections. In this video, I'm going to just tell you what a correction is. So the correction is after price makes a high or a low. So remember this. Let's go ahead and write this down for you. Correction is when price, or let's say it like this. Corrections happen after price makes a high or low. New high, new high. So that's the biggest point. New high or new low. So this normally happens after a new high or a new low. And why does this happen? Because the market is taking in all the FOMO traders, the greedy traders, and it is what then is going to do is going to realize there's so much money on the line because there's so many people buying or selling this breakout. In this case, they're buying this breakout and it's so much money on the line that it can use, right? And also as well, this means wherever price ends up stopping, this also lets us know that there is in this case, there's a amount of sellers here. So there's a bunch of sellers here and there's more sellers than there are buyers at this point. So buyers, what will normally happen is a lot of people will have this breakout. So there'll be a lot of money on this end of the stick. So like right around this area. And then there'll also be people that are really, really late to the move, which is up here, which these guys normally put in a lot of money because psychologically, people who end up buying at the top, they think that price is going to still continue to go. And they normally FOMO because prices mooned so much, it's went up so much. So by the time that people enter here, they feel like they missed out the whole move. So they go extremely hard on their position because they felt like they missed so much. So they're trying to grab as much as possible, thinking it's going to continue to go up. So psychologically, which is what I'm pretty big on when it comes to trading, there's going to be two areas where people are going to normally have positions. Initially, the initial breakout, which more of the advanced traders that's been trading breakouts, they're normally going to trade around this level. And then the beginner traders, which are going to have levels over here at the top or probably mostly in the middle. So roughly around these two areas, there are a bunch of orders, a bunch of buyers in the markets that are just trading based off of emotions. So what I like to do is I also think of price coming to this level and saying, hey, there are more sellers right now. We've reached a level where there are more sellers in the market and we cannot push past this, even though we have a lot of buyers in the market right now. But sellers are not, there's so many sellers at this point, and we only have, let's say, and these are just the example numbers, like the market has trillions of dollars in it. But these are just examples, right? So let's say at all the FOMO traders and everything, we only have 500 people in that market, right? But the buyers are only going to go up to 1,000. They reached 1,000. So now they're like, oh, bro, we don't have more buyers than we have sellers at this level. So what then this causes is the market to think, okay, there's 1,000 sellers here, but we have 500 buyers. What we need to create is now we need to take out all the buyers so we can collect all the money that they have, and then later on go back up and try to break out of that sell range. So the sell level I meant. So then the correction happens, and normally the correction happens from the initial breakout because then all stops should be out. So the people up here, they're liquidated about time price is halfway. They're mostly liquidated, but by time price is halfway. And then there's other times where price has to take out these guys, and they liquidate them as much as possible, go back into that range, which is very important for the continuation, because the continuation is actually where our entries, stop losses, and take profits are going to be set. That's going to be in the next video, but to explain consolidation or continuation, my apologies, to explain continuation, bro, so many C's: consolidation, continuation, correction. To explain the correction is basically telling you the market is grabbing liquidity based off of people FOMOing into the market. So you're basically using a correction in a way that most people don't look at it, more of in a psychology way, is because there's people in the markets FOMOing, there's people just getting into the random breakouts and making poor decisions based off of what price is doing, and they're not thinking long term about the situation. Me, as a trader, I'm going to teach you guys how to think long term, but you can still trade day to day. But when you trade these day to days, you're going to think in a sense of like, I'm going to trade this day for a buy, but I know this buy can go long term, so I can hold a long term. You want to be able to take a position and be able to scale into that position. But once price gets to a certain point for that day, you can scale out, but still hold that trade. So if you don't know what scale is, it's basically getting into the position and then start adding positions and then holding for that, that day, that week, and then being able to hold that trade and continue to maximize on the trend. And trend is like what we talked about in the first video. So this is basically what the correction is about. Is normally about when price is pushing back down, grabbing as much liquidity as possible. And normally you would want to look at this correction. So notice how we marked up our charts on the 1 hour or 4 hour time frame. The correction you're going to look at on the correction, wrong word, correction is monitored on the 15-minute time frame. So when a correction starts to happen, you want to start monitoring this on the 15-minute time frame. And the reason is because if you look at it on the 1 hour, it's just going to be a candle or two going back down. It's still visible, but the reason why we want to get into a habit of using that 15-minute time frame to wait for that the correction is because it's going to play a big toll into knowing when the correction is over, so that way you can get that entry on that 15-minute time frame when price is back above those swing highs. So basically ICC, all we are doing is waiting for that indication to tell us where price is going to head to. What level do we need to set our TP at, because this is going to be where our TP is, right? Because this is the level that sellers are going to be at to push price down. So if we're buying, we're always buying into the sellers. And if we're selling, we're always buying, or we're always selling into the buyers, because those are the people that we are basically going to swap our contracts for. We're going to swap our contracts with the people that are waiting to basically purchase them right off bat because they're already sitting at that level. So with this being said, the easiest way to understand a correction is thinking of it as if a new high or a new low is made, then think of liquidity, think of the market trying to take all those people that are in a breakout, take them out before making the next big leg up, which would start the trend. So watch video number 1 again. Remember that trend is very important because higher highs, higher lows are constantly being made. And the only way price is going to break those levels is if the trend is reversing. But if the trend is not reversing, then you're going to constantly get those higher highs and higher lows. And if you look at this, we see that price is giving us that indication. It corrects, and then back above that market, we can capitalize on the rest of the trend. So that's what I'm talking about when I talk about swinging my trades and holding my trades longer, because if price is trending, it will not break its structure, so it will not break its support levels. And the longer that it holds these support levels, the longer we can hold our trades, right? And we can keep targeting new highs. So our first position will look like this. So if we have our indication, our correction, and then the continuation, our trade will look like this. Stop loss below the previous level, and then we'll target the previous high. But what this calls us to do is, since we're targeting the previous high, if price is truly on an uptrend, then it will end up creating a new high, which we can then hold for, and then we can maximize our profits that way. So that's basically what a correction is. And if you have any questions,